Welcome to Money Sense. I'm Jamie Williams, Wealth Advisor at Ellenbecker Investment Group and a certified financial planner. Today, privileged to have our guest Dick Schiller join us from Pavlic Investment Advisors. Dick is a chartered financial analyst and also a senior wealth advisor that works very closely with Ellenbecker in terms of our fixed income strategies, and also a great general strategist advisor to us. So we really appreciate your presence and your ability to be a friend of the IG. Dick, thanks for joining the show.
Awesome. Thank you so much for having me. Great to be here, and our first one on video.
Yes.
So this is a learning experience for us, and I'm sure it'll be just as good as the others.
Absolutely. Got a little facelift here in the studio. It's looking really good. So I know here we are. It's double-digit July already. How did that happen? I have no idea. We're going into the third quarter of this year, and I think the market in general has got a lot of attention all year long. I'd say for the most part, it has attention pretty regularly, but I think now more than general, I would say. So we're going to talk a little bit today about the markets, fixed income specifically. That's one of your areas of expertise. But why don't we start with talking about the bulls and the bears? This is the oldest probably theme to the stock market there ever exists. But any thoughts on bulls and bears? What does that mean to us?
So true, Jamie. And if we rewind back and just you hear often a bull market or a bear market, and what does that really mean? The history goes back to a bull market will lower its horns and attack up, hence an upward facing stock market, a rising stock market. And a bear, conversely, throws its big paws and claws upright and attacks down, or a downward falling stock market. So that's some of the history behind a bull and a bear. And between these, you say a tale of two halves. In the first half of the year, it's really been a tale of two quarters, because that first quarter, you remember the war in Iran, entering Venezuela, some geopolitical issues that came up that no one had on their 2026 outlook. I always joke that it's very humbling once you hit February, you can just toss all those January notes away. And then once in the second quarter, we saw a little bit more just cooler heads, if you will. And the market, I think, in a way, just stopped paying attention to Iran. Not that it's not a problem anymore. I think we saw that in the last week. And even today, right, we're having headlines that the Strait of Hormuz is closed again. So still a very bull versus bear debate going on. And so in prepping for this call and video call, I thought I would share just some of the some 10 greatest bullish charts. So right now, these are 10 reasons why we should be bull, right? Attack upward. And then also maybe 10 bearish charts, right?
Okay, that sounds great. I know that you love charts. I'm a chart guy too.
Exactly.
There's so many much information out there that we can pull from.
A picture tells 1,000 words.
Indeed. But on the bear and bull, we even here at our Ellenbecker office, we've got a beautiful mural in our lobby. On one side, there's a bull going up and there's a bear going down. And, so really fascinating. It's just like one of the oldest stock adages. And, on bull markets, when was the last time, before we get into the charts, we really had a serious bear market?
I mean, if you want to call a bear market a recession, you'd have to actually go back. I'd struggle with whether or not COVID was a recession, because that was 2 months, and then the government just threw infinite amounts of money at it, and the economy really was flush with cash. And it's hard to say that's a recession if you're sending stimulus payments out to businesses and individuals. So before that, I mean, you can easily go back to the GFC. So I mean, have we had a recession in the last 16 years, 17, 18 years? I mean, probably not, depending on if you count COVID or not. Within the market, though, you can also define a bear market as a 20% drawdown.
So 2022.
2022, you're right. Inflation hit 9%, and it's came back to now we're not at 2, but we're 3 to 4 right now, touching 4. So yeah, you're exactly right. And I wouldn't really call 2022 a recession. I don't think many people are, but I remember those times we had radio calls and being like, this doesn't feel great. This
Yeah.
is a 20%, 25% drawdown in the stock market. And I remember those times well.
Bond market did not fare well during that time.
Very much so. No, we'll
Either.
talk about that
So
in our second segment too. With
Definitely
fixed
will.
income.
Definitely will.
Man, yes.
So being a chart person, and I know maybe you're going to walk through some data and just share a couple thoughts on why are we in a bull market?
Sure. I'll start with the bull case. I am naturally an optimist, so I am attracted more towards the bullish argument than the bearish argument. But even to preface this, I think at all times you can probably give 10 bull charts and 10 bear charts, right?
Yeah.
At all times. There's never, and when and if there's ever a case where you're like, I just can't come up with a bear thesis whatsoever, it's probably the peak of the market, right?
Yeah, exactly.
If there's a good balance, and honestly, I feel like there is kind of I kind of agree with both sides, right? There are reasons to be bullish and reasons to be bearish. That's a sign of a normal market. So maybe I'll just start with a couple of the bull ones. And the first and foremost point that I think the bears have missed is that earnings growth has been really, really strong. And then the
Right.
pushback I'll get from that as well. Yeah, we're coming from 20% earnings growth, but it can't stay up there. It's going to fall back down to 15, 10, and then go negative. And, when we look at this chart I'm looking at, in 2022, we did have a flat earnings growth year. Since then, though, it's pulled back. 3-4 years here where we're up over 20%. And that's it corresponds with the S&P 500.
Right.
So if you think about the overall market, 23, 24, 25, those are all 20% plus years of growth. And lo and behold, we're halfway through 2026 and we're up 10%. So almost a little ominous how kind of consistent that growth has been, but it's really been driven by earnings.
It really is. And, we talk about the Mag 7, which are the big tech companies that are kind of driving that tech growth. Now there's even more names on the table that, more than 7 out there. But in terms of the 493, the other ones, I think you're talking about how well those companies in those sectors have performed this year as well.
Right. We have seen a big broadening out of just share price performance, and you come out of the inflation of 2022. It was the Mag 7, right? The ChatGPT hit late fall of 2022, and everyone was like, "What is AI? How is it going to impact my business?" How many industries can benefit from this? How many industries can get wiped out from this? And Microsoft was the first one investing in OpenAI, ChatGPT. Google's building Gemini Pro. Now we hear Anthropic, Claude. Honestly, it's like I try using all of them, and I'm put the same question in 4 different tools and see what gives you a better result. And it's fascinating watching the difference in market share between some of them. But to your point, what's been most evident in the last year has been coming out of 22 into 23, 24. It was Mag 7, Mag 7, Mag 7. They're going to control the AI universe. Everyone's going to be going to Google Gemini to get their AI.
Yeah.
Why do we need to own anything else? And what's been really evident in the last 6 to 9 months, 2 to 3 quarters here, has been that these big Magnificent 7 companies are spending tons of money. Basically, they have profitable businesses, but they're taking that money and they're spending it on capital expenditures.
CapEx.
So what is CapEx? I think that's a great question that not necessarily the average investor knows. If you make an expense, think of it like your home, right? If I redo my roof, well, hopefully that increased the value of my real estate, right? So you could consider that a capital expenditure. If, let's say, my dishwasher goes out, smaller expense, but you're probably not going to sell your home without that dishwasher working. So that's probably an expense, right? So it's a little bit of an accounting game, but because how the market shifted has been, instead of just focusing on the Mag 7, ChatGPT, the Gemini at our fingertips, they're saying, well, these Mag 7 companies, they have so much cash flow and they're spending it where? And the answer has been the memory names, right? Semiconductor equipment names, KLAC, Applied Materials. SanDisk on the memory side. Yep, Western Digital, Micron. And so some of these names just gone parabolic, but then also there's been a wide variety, small cap value, small cap growth. Small cap's done great this
Incredible.
year, right? And just the Mag 7 alone on a year-to-date basis is actually down for the year.
Mm-hmm.
So pretty astonishing. You have S&P, which is market cap weighted, up 10%, but to have the Mag 7 most of the largest companies in the S&P 500 actually be down.
Case for diversification, right?
That's right. Exactly right.
So I know that you mentioned that we'll pull up a few more charts here, but you're kind of an internal bull. If there was one area that you'd be concerned right now on the bear side, what would you think that might look like for you? Or what would that be?
For sure. I think clients naturally, especially if they're politically inclined, they want to start with geopolitics, but that's not actually, in my mind, the first and foremost thing that's going to really affect the equity markets and the fixed income markets for that matter. I mean, I see things that, and this is a great chart. If I could just summarize it, AI spending is real. It's not just hype. And so it shows AI spending going back all the way from 1990, which was before AI was really on the table. But this is categorized as business spending on computers and data center hardware.
Mm-hmm.
And it had some movement from 1990 to 2000, right before the tech bubble, and then it essentially pulled back from there. And then it's been since pretty flat till about 2023, right? ChatGPT. All of a sudden, all these other vendors, we need to get our own products, and it just has exploded from roughly about 150 billion in adjusted annual spend to now 400 billion. 100 billion to 400 billion in 2 years.
Yeah.
So that's the bull argument. I mean, is
it going to keep going?
How can you ignore this, massive spending, and everyone's making money, especially if you're selling? I mean, if you're printing money.
You're missing out.
Exactly. You're printing money if you're selling chips that go in data centers, right? Like, you want to buy this? Well, price just went up from $10 to $20, in a night, right? So the bear case, you can use that same exact chart and look through it from just a different lens and say, but what if
that might be the reason why
that growth doesn't look like an elevator just up and to the right anymore? What if, and it doesn't have to go negative. All it has to do is stop going up quite as quickly and maybe just start, second derivative starts slowing.
Go into an orbit rather than off and out.
Flat, market will not like flat.
Right.
Market actually will not like slowing growth either. That's, I think, especially with earnings coming up here in late July, that's what everyone I think will be focused on and watching. And the reality too is that the indices have a lot of concentration to, the Mag 7, but also all the other names that have benefited from AI spending. So biggest bear case, I would say, is watch this number, watch what the Mag 7 are saying on spending. If even the market sniffs out that, hey, they're not going to spend quite as much, or this is my favorite line, they need a digestion period. We spent a lot of money. We need to kind of assess what we bought, make sure we can sell what we bought, all the data center capacity we built. And if that comes out in the conference calls for the earnings quarter, I think there could be a pullback.
Tie that in with interest rates, which we'll be talking a little bit more about that in our next segment. But I think back to the AI and that hyperscale build, if you will, and all the things that are going into it, it's not built out yet. There's electricians on the ground. There's so much going on with that right now that I think you're right. Are we building something that hasn't achieved the scale that it's going to need to be yet?
Right.
And what other disruption or other technologies could come along? I always think about the VCR. Mm-hmm. Those used to cost like $500. By the time they were obsolete, they were $50. Right? At Walmart. So what does that mean for AI? Is it going to get cheaper? Is it going to get easier to use? Who knows? Those are things that remain to be seen.
And that VCR is probably worthless today. You couldn't sell it for $1 if you wanted to.
So true. A case for recycling, right?
Yes.
Electronics recycling. Yes. So very good. Well, we'll take a quick break on that, and that's our first segment.
Money Sense is brought to you by Ellenbecker Investment Group. If you're looking for a trusted partner or ready to elevate your financial plan, you're in the right place. With multiple Better Business Bureau Torch Awards for ethics and integrity, Ellenbecker combines expertise with a team member you can trust. Meet our advisors and explore financial resources at ellenbecker.com.
We're back. So Dick, so many things to talk about today. Amazing. Obviously we love charts. One of the things that your area of expertise falls in is fixed income. And It's such an important area of our client portfolios because we don't want to just guess at how much money people are going to need to protect on the downside.
For sure.
It's actually in our core pillars, in terms of like our investment philosophy here at EIG. Spend a lot of time thinking about that. So if we do go into a bear market, our clients don't have to think, wow, I can't spend as much. I can't go on vacation. Will I have to go back to work? So those bonds are key. I want to talk a little bit about that. If you were to kind of map out what the bond landscape has looked like over the last 5 or so years, anything come to mind?
Yeah, certainly. I love how you started off with, know what you know, and you started off with spending. And
Yeah.
you should know your cash flow. Ideally, you should know, okay, what's coming in, right? That's really a known for most people, unless they may have a business with variable income or something, and what's going out. And that also should be a decently known, and maybe not the same
Right.
for everyone. Maybe there's some variability, but I think most
right.
clients generally have some sort of, for lack of a better word, a budget. Right.
Mhm.
So some
Yep.
sort of, hey, this is roughly what's coming in and this is roughly what's coming out. And, like in the last segment, we talked about bull case here, bear case there. I may wake up and be on this side of the aisle, I may be on that side of the aisle, right? And same, and,
Yep.
a client may too. And so the key to starting with planning, as you guys do at Ellenbecker, is to figure out what our known knowns are to our best
Sure.
estimate. I mean, another variable that you have to consider is health. And what's your, our financial planning tool politely calls it, the end of plan, which is if you and I know, no one knows, right? No one knows what our health is. No one knows when our last day on earth is. So those play into, your financial plan, and, fixed income plays a part in that, right? So there's a piece of this where you may say, hey, and I don't want to tell anyone that we're going to make more than the stock guys, right? We're not.
It's just
Over the
not
long
our
term,
it's not our thing.
we're not, right.
Right.
But if you want to be an all stock, probably make double-digit returns over the long term, you're going to have to stomach the ups and downs, right? The roller coaster. And some people have that vision and say, that's what I want. If stocks make me 10% over the long term and bonds make me 5%, why on earth would I be talking to the bond guys?
Right.
I want to be the stock guys. And that's a risk-seeking type of attitude.
For sure.
On the other side of the equation, people may say, I can't stomach, why should it go up and down even in a day? And so usually, though, 90% of clients are somewhere in the middle, right? And that's what you guys do so well, is finding that right balance. Is it maybe 90-10, 80-20, 60-40? We all have clients across the spectrum there. So start with what you know, and then expanding that within the fixed income world. The benefit of, let's say you're in a 60-40 portfolio. We've been in a higher for longer interest rate environment for the better part of 3 or 4 years now.
Probably much longer than I would have ever imagined, actually.
Yeah, I mean, I remember saying at some of our conferences, like, higher for longer is here to stay. It's being overused, just like transitory was a little bit overused, but turned out not to be true.
Right.
I think this higher for longer, overused, but turned out to be true and is still true. And I think I'd reiterate it even now, because we really need to see inflation consistently be slowing or growth consistently be slowing. Both of those look upward and to the right.
That's right.
Growth accelerating, inflation accelerating. So because of that, that puts this higher pressure on interest rates. We've been in a trading pattern, though. Like you said, I love charts. So I'm looking at a 5-year chart of the 10-year U.S. Treasury. So you want to loan money to the U.S. government. What's the rate you're going to get today? About 4.6% per year. That's a decent return. If someone has a large enough nest egg and doesn't want to stomach the volatility of the stock market, they can totally take that in and collect their coupons. Also, over the last 3 years, that's been pretty range bound between maybe 4%, 3.75.
Yeah,
maybe on the low
it dropped below 4 ever so slightly.
Yeah, and we've risen above 5 ever so slightly.
Yes.
And the scary thing is, I think the stock market starts to catch a cold if we go over 5% and at least stay there for a while.
Right.
And, looking at the chart now, I see 1, 2, 3, maybe the peak here was maybe like 4.8. I don't think we even reached over 5, but we hit that brief stint over 5 and then pulled back. So the equity market was like, oh, it's not a big deal, at least yet. Right. So we've been range bound.
So we have a new Fed chair.
Yes.
We know the Federal Reserve has a dual mandate: keep unemployment low, keep inflation low. Right. How tough of a job do you think that's going to be? And I know I wouldn't want that job.
I wouldn't want that job. Gosh, he is, man, that's a task that even if I was nominated, I'd be thank you for that consideration, but I will pass. I would much rather be here doing
So
these radio
I
shows.
think they're considering potentially some possible rate increases too, right?
Yeah,
Possibly.
there's what's called the dot plot, right? Which is, I think people always think about the guy, right? Is it Powell or is it Warsh? And
Yep.
I just want to remind everyone that it is a committee of
It's a
people,
full committee.
right? So Warsh can say, I'm taking rates to zero. And if the committee says, no way, they still have to go with what the committee says. So that's the first piece. And then they'll put out their dot plots. The interesting thing is Kevin Warsh has said, I want to get away from these dot plots because we're basically signaling to the market what we're going to do before we do it. And if you get into that consistent path, you're getting to somewhere where you're not really being data dependent anymore, right? Because like the dot plot is essentially saying this is where we're going to be 6 to 12 months from now.
Yep.
But that means we have no data between today and 6 to 12 months from now. So how can you be data dependent?
Yeah,
right.
And we've seen that whole thing shift. Like
yes.
Last year, there was a big expectation, and then it didn't happen.
Right.
That rates were going to go down,
right?
And they stayed higher for longer, like you said. So,
and the market has their own forecasting tool to predict where they think rates will go. So I believe the last dot plot, take it for what it's worth, because Warsh is like, I want to get rid of that thing, was for still flat to even potentially lower rates. But the market futures of where the Fed funds rate would be is actually higher by 25 basis points.
Sure.
So,
So we have a normal yield curve right now.
We have a normal shaping yield curve, and the Fed funds rate is that shortest end of the yield curve.
Okay.
So, and if you're shortest end, if you can loan money overnight at 4%, why would you loan it out 10 years, take on the interest rate risk at 4.5, right?
Yeah.
So that's how it all pushes, all those further out yields to be higher because the short-term rate is higher. So we'll see. Market thinks, one more increase by the end of the year. If oil stays elevated, if the war in Iran picks back up, yeah, I could definitely see it.
Is there anything that comes to mind for you around people that if they have cash on the sidelines? I know we're not market timers, but if they want to hold some funds, maybe for a special project or something like that, should they be? What types of instruments would you suggest for something like that?
Yeah, I mean, I always start with your liquidity. Kind of how we started out.
Mm-hmm.
What's your income? What are your expenses? And then let's start with what should we set aside. And the general rule of thumb is to take that expense number, your monthly expense number, and to put at least 3 to 6 months aside. You can play it a little bit cute with how much money you want in your bank account versus maybe a money market fund that's really liquid. I always tell clients, if you're coming to me every month asking for a one-time distribution, let's talk about converting this into a recurring distribution and setting up auto payment.
Let's set up some realistic expectations around distributions. Makes sense.
And then sometimes people say, but that's only this month. But it's a new thing. So, I think getting comfortable, everyone has a different number, right? Some are 3 months on hand, some are 12 months, some are 12 months on the long end, and most, I would say, are within 6 months. So, and that's the basic building block, right? So cash in your checking account, maybe money market fund if you want a little bit more liquidity beyond that. And then you can really start looking into, treasury bills, investment grade corporate bonds. We have a 10-year bond ladder as our default.
Yeah, I want to talk about that a little bit.
Yeah.
As far as like what you've been seeing over the last couple of years.
On the short end, we're at that 4.5 range of where we can get. And you might say, hey, well, the money market fund's at 3.5. Is it worth the extra percent? That's kind of a personal preference thing. My belief is if you've set aside, like do both, right? If you've set aside your 6 month of living expenses and hey, you have extra cash left over, well, let's find a new home. It's kind of a bucketed approach.
Sure.
Let's find a new home for that piece of capital. So, yeah, and that's on the shorter end. And where you were headed with the longer end, we do have a positively shaped yield curve, meaning that short-term rates, let's just call it 4.5%. For round numbers, long-term rates, if we're buying an investment grade corporate bond out 10 years from now, we're closer to 5.5%. So if you take, and it's pretty straight.
What's the duration of that, would you say, in terms of if people were to place money in something like that? How long would they expect to achieve those higher yields?
Yeah, so I always focus on yield to maturity because at maturity we know we're getting our $100 per bond par value back. So, there's some thought of, we're going to be some fixed income money managers buy and sell bonds and try to make a spread thinking that rates will go higher or lower. It's almost we don't really know where rates are going. We have this higher for longer belief, but that also means that if we're buying and selling, especially with bid-ask spreads, we're not really able to add a tremendous amount of value. And if we do add value, it may be eaten up entirely by transaction costs, right? Because transaction costs are higher in fixed income than with a stock portfolio. So, and where rates are across, today, we're a positively shaped yield curve. Think of it from 4.5 to 5.5. If we hold those yields to maturity, 10% is maturing every single year.
Yep.
And, that a weighted average, if you have 4.5 on the low end, 5.5 on the long end, you're at about 5%, right, across that 10-year bond ladder. And like we said, the stock guys and girls, they'll make 10% a year over the long term. If we even have a 50-50 portfolio, you're at a 7.5% expected return over the long term.
Right. Absolutely. That's
exciting.
What we could plan for, right?
Yes.
Could double our money in about 10 years
exactly
with those numbers.
Rule of 72.
Yes,
right?
one of my faves.
And that client doesn't need to necessarily be on the high roller coaster, right? Of going through all the ups and downs. Again, it all kind of comes back to asset allocation, where clients most comfortable with. And I think that something that both we do really well is we're not going to say, you need to be here. This is where Bitcoin's going to $1 million, so we need to invest all your money in Bitcoin, right?
Yeah, right.
And
No.
we're also not saying, you need to be 100% in stocks right now.
Sure.
Right? Some people may be extreme AI bulls, and we could tailor a portfolio to match that if they really want to be there. But my job too is to say, this is the risk.
Yeah.
Right? This is what could happen. If you're okay with it, fine. I think most people say, okay, let's get more balanced.
Yeah, let's keep some safety in there. The bond analogy for me is it's ballast, right? Keeps the ship right during times of volatility. I very much particularly like the strategy that you run for us because there's so much predictability around it. I was meeting with some clients the other day where we sat down and they're planning these big house projects that are going to span over the next 2 to 3 years.
Sure.
Or, new driveway, new sprinkler, new, whatever, kitchen. It was perfect because I'm looking at the bond portfolio and I'm tying that back to their IRA distribution requirements for the year. And we're like, we have a bond coming due perfectly right here. We have another one here.
Yes.
We don't have to sell out of, a packaged mutual fund product that might be up or down, but we have predictability. So that's why I love it.
Julie Ellenbecker does that so well too, structuring it just like that. And she says, the market's going to do what the market's going to do. Let's focus on spending, your cash flow. Let's line it up and let's use those bond maturities. And, we can roll the bond ladder, and we've been doing that at about 5.5%. We can give money back for spending, right? Make a distribution. Yeah. Or what's I think been less is if we're rebalancing because stocks are down. And one day, stocks will go down. No one's rooting for that, but it will happen again.
Absolutely.
And what we'll be saying on this radio show is, hey, your bonds are maturing. I know it feels terrible. Take that maturity and go add it to your stock portfolio, right? Do rebalancing.
You have that, or on the other hand, stocks are doing well. So maybe we just go ahead and let that bond renew out at the far end of that curve, and you know what you're doing. Corporate bonds over other types of bonds. I maybe want to touch on that here in our upcoming segment.
Ellenbecker Investment Group is officially launching our brand new program, The Wealth Seed. This program is designed to give you high-quality financial guidance tailored to your stage of saving, no matter your experience level. As part of this program, you'll get a growing library of short, easy-to-understand financial podcasts, monthly educational emails, interactive workshops, and curated tools like book and media recommendations. Plant your wealth seed today and start growing with us at ellenbecker.com/thewealthseed.
So So many great things on the topic of fixed income. I always refer to bonds as a unique animal just because they are. They don't trade like stocks. It's not the idea is like buy low, sell high. I mean, obviously you want your yields to go up over the time. So that's a big thing.
Mhm.
But with respect specifically to corporate bonds, what are your thoughts there versus some other bonds that exist? I mean, we're talking for long-term asset allocation strategies for our clients.
Yes.
Why corporates?
Yeah, great question. And you do have options within fixed income, right? So think of a bond just in its simplest term as you are loaning money to another entity. If I loaned you money, that technically is reflected of a bond, pay me interest over time. And take that back to a corporate bond. You are loaning the company money to go invest, spend, CapEx, whatever they want to do with it. Some of the big Mag 7 are now issuing corporate bonds, believe it or not. It used to be all cash on their balance sheet. Now we're getting some debt. So they're going out, issuing bonds. You as an investor give them money and they're going to pay you coupons back. When the interest payments were 2-3%, that wasn't very exciting. Like our pitch was, hey, bonds are going to keep you off the volatility of the stock market. Now that we're able to achieve corporate investment grade bonds 10 years out in that 5.5, even a little more, though earlier this year we're a little more, something close to 6, people like that's real return.
It really is.
I mean, you could probably say most people would be happy with a 6 to high single digit return in the stock market. Right. So they're almost becoming, really a great partnership act, which is healthy. It's where it should be. I think the COVID 0% interest rates was not healthy or normal for anyone. So we're back to a much more balanced market. And then just to follow up on your question, okay, that's great corporate. We talked about between 4.5 on the short end to 5.5, 10 years out. Within the municipal bond landscape, that's probably the second most common thing we see.
Right.
And the rates are definitely lower because they are federally tax exempt. So the rates, though, that you'll be able to achieve, let's say it's in the 3s. Well, if your tax rate is in the 12% tax bracket, the way you mark that up to a tax equivalent yield, you take 3.5 divided by 1 minus your tax rate. And so that tax rate is very small. That 3.5 maybe is a 3.7, right? And it's like, well, we could start in corporates at 4.5. And, even on the longer end, we see the same thing where it's a 4.5 versus a 5.5. So if someone is in that 37% tax bracket, and also I think there's a little bit of a psychological barrier where someone's like, I'm going to do whatever it costs at all costs and not pay the federal government.
Yes, eliminate taxes at all costs.
Yeah, reduce taxes at all costs. We can do that. The other thing that I think is not as widely talked about, everyone focuses on the rates and tax equivalent yields, but there is a lot less liquidity within the municipal bond market.
Exactly. Yep.
We've gone through a couple of portfolios, Jamie, where we've had to set the municipal bonds out for bid. And often, I'm like, well, let's not do it on a Friday. Let's do it on a Monday. Let's start first thing in the morning so we can get as many eyeballs on this and let's place them out to bid and we'll take the highest bid. Generally, we put that bid out there for a couple hours. And so it's out there and we might get 10, 15, 20 bids, take the highest bid. With how we've structured the corporate bonds, especially over the last 4 or 5 years, is always having a liquid market to be able to buy.
I like that. So transparency as well, right?
Yes.
With the rating agencies.
Yes.
And
that's, years ago, we used to do more work in variable rate bonds, but there just isn't the liquidity there. And, God forbid, client passes unexpectedly, right? 65-year-old, we had a 10-year bond ladder, and you know what the beneficiaries say? I don't want to own this stuff. I want the cash. I maybe want a distribution. That's a real benefit to having liquidity. Not to say we can't sell the municipals, just a little harder, right?
Exactly.
We can do it in the corporate side really, really easy. I mean, within seconds, we're having different bid and ask spreads that we can execute on position changes within seconds.
So on that note, I know bonds, for me, they provide peace of mind. Right. They're just like a very important element. Like you said earlier when we were just sitting down, it's kind of a boring market, right? The bonds aren't really meant to be exciting, like agentic AI hyperscaling trade, that we're seeing. But I think for the vast majority of our clients, and I touched on this earlier, was if the stock market's down, we might be spending from bonds. But if the market's up, maybe we're spending from stocks and we're rebalancing along the way. But with the sentiment of, the theme today, bulls and bears,
Yes.
is there anything that you have in your mind's eye that you would say to somebody if they were feeling a little bit, reluctant, or, maybe they still need to, make some decisions about what they want to do, whether it's an inheritance or maybe they, they're just about to retire. Is there anything in your equation that maybe you want to share?
Yeah, I think first and foremost, reach out to your wealth advisor, right? Like, we have so much experience answering exactly those types of questions. And I think when you think about your own financial path and journey and where you're at and the ins and outs, that's one case study, right? The sample size is one. You and I and all the advisors at Ellenbecker take that case study times hundreds, right? And a lot of different examples of what's worked for people, what hasn't. So I think kind of our number one job is making sure that we have you fit into somewhere that works for you and that you can sleep at night, right?
Absolutely.
And and every client is completely different, right? So the worst case scenario, my nightmare advisor scenario is we come to an agreement, that, hey, your asset allocation should be here. Stocks tumbled 20%, and clients like, whoa, I didn't sign up for this. This is way too much for my risk tolerance levels.
Yeah.
And the want will be there to get more conservative at exactly the wrong time, right? So the want will be, okay, sell my stocks. Gosh, those fixed income guys are geniuses. They're clipping 5% coupons, put it all in bonds. And in my shoes, I'm going to say, believe it or not, I'm going to say, don't do it. Keep it. Take the bond maturity and go buy your stock portfolio, right?
Yeah, there you go.
So that's that's why you hired us too, right? Yeah. We're that I consider more of like a coach, right? We're not the quarterback, right? It's the client's money. They're driving the ship, but we're going to help, guide the client to help fit what their needs and risk tolerances
I think there's so much to be said too for what, why are the clients across the table? What's the driving, motivation?
Right.
Because for some of our clients that have done well, they've followed, the prescribed order of getting things set up a certain way. They've done their estate plan. We're using tax management, right, to their advantage. And maybe they're not going to spend it. So maybe they're planning for their legacy, which is a huge area of planning, intragenerational planning, helping out your kids, or maybe making sure that you're going to be in a position where you don't have to worry about a long-term care event, right? Things like that. So on that end, I'm just curious, is there anything that people shouldn't be doing right now in your mind? Is there something, a pitfall or something that I can share an idea, but do you have anything that you'd say, hey, fear of missing out? Like,
I feel a lot that there's this is going to go on forever, right? Like kind of like how I said earlier, we've had 3 years of 20% plus equity market returns, and client made 10 years, 10% year to date. Client may come in and say, all right, see you next year, another 20%. And just to kind of level set that what we've gone through has been an extraordinary period in the equity markets, largely driven by AI technology companies. And let's see how this all shakes out, right? And I think, if you, I'm not necessarily I don't really love the comparisons to a one in the tech bubble, because I think we do have a lot more earnings growth underneath than
yes, there's more under the hood now.
Yeah, you have pets.com, didn't have to make money, whatever, IPO, right? So now I think these companies are making money, but the question is, will it be enough money relative to the amount that they've spent on data center AI build out? And that story's still TBD. I think the concern that maybe AI won't bring about productivity, I think that's kind of been put to bed. I think we've seen already just Copilot, Gemini.
It's already
here,
eking its way into
the
working world
everywhere,
and outside.
Everywhere, yeah. I mean, just as something as simple as like, one of my passions when I'm not in the weeds of this is gardening.
Yeah.
And I'll take a picture and be like, what did I screw up? Do I need to prune? Do I need to water? And it says, you actually need to add milk. And I'm like, well, I never would have thought of that. But if I were to have been Googling, researching, saying this type of plant, I probably would have got the wrong answer and spent 20 minutes researching.
That's amazing.
So, I think productivity is here to stay. Pitfalls, just be flexible, be nimble, and nothing lasts forever, right?
Yeah, and I would, on that end, I think discipline, having the right approach, understanding what your risk tolerances are, making sure that you've discussed these components with what makes sense, what's important for you, because everything is important. There's a book, The Most Important Thing, and it's an investing book. And the thing is everything is important.
Yes.
It's like the most important thing is this. The most important thing is this. So the most important thing is to be disciplined and sit down and plan and take the time to work with your advisors and work with great people.
I agree.
Partners.
There will always be 10 bull cases and 10 bear case charts, right?
That's absolutely correct.
We'll be able to have that discussion every single quarter if we wanted to.
So very good, Dick. Well, thank you so much for joining us today.
Thank you, Jamie. Thanks for having me.
It's been a great run with Money Sense here with you joining us about every quarter over the last several years. So thank you.
They've been great.
So thank you for joining us today. Our podcasts air on Tuesdays, and we appreciate this. Hopefully we've made a difference in your life. And before we plan, before we advise, we always listen. Thank you.
Thanks for listening to this episode of Money Sense, brought to you by Ellen Becker Investment Group. If you found today's conversation helpful, we encourage you to share it with a friend or family member, and be sure to subscribe wherever you listen to podcasts so you never miss an episode. At Ellen Becker Investment Group, we believe that education is the foundation of confident financial decisions. That's why we're proud to bring you insights from experienced professionals to help you build true wealth, beyond just money. Please note, this podcast is intended for general informational purposes only and does not constitute personalized financial advice. Before making any financial decisions, we recommend consulting with a qualified advisor who understands your unique situation. For more resources, visit ellenbecker.com. We'll be back soon with more insights to help you live with clarity and confidence.